In this video, we will explore about the settlement mechanism used in financial markets. Specifically, we are going to look at how different types of derivative contracts are settled when they expire. Since October 2019, there has been a clear rule. If you are trading index futures and options, these contracts continue to be settled entirely in cash. However, if you are trading futures and options on individual securities or single stocks, any position left open on the expiry day must be settled through the actual physical delivery of those shares. Moving on, let us break down how futures contracts are settled. There are two main stages to this process. The first is called the mark-to-market settlement, which we often just call MTM. This happens continuously at the end of every single trading day. The second stage is the final settlement, and as you might guess, this only happens once, right? On the very last trading day when the contract actually expires. Let us look a little closer at that daily mark-to-market settlement. This is essentially a process where the clearing corporation adjusts your margins based on how the underlying assets price moved that day. The way they calculate your profit or loss depends on your specific trade. For brand new contracts you did not close, they compare your trade price versus the day's settlement price. For contracts you brought forward from yesterday, they look at the previous day's settlement price versus today's settlement price. And if you bought and sold on the same day, they simply compare your buy price versus your sell price. In the end, the clearing corporation acts as the middleman. They collect the MTM loss from the losing member and pass that exact profit to the winning member. Finally, your open positions are reset to today's settlement price, ready for tomorrow. Now, how do we determine this daily settlement price for the MTM process? Under standard conditions, it is based on the volume weighted average price of the contract across all exchanges, specifically looking at the last 30 minutes of trading for the day. But what if the contract did not trade at all during those last 30 minutes? In that case, we use a theoretical calculation. The formula is F equals S multiplied by E raised to the power of R multiplied by T. Here, F represents the theoretical futures price, S is the value of the underlying asset, R is the rate of interest like the MIBOR rate, and T is the time remaining until expiration. Next, let us discuss how this daily MTM settlement is actually executed. First, it is strictly cash settled. The mechanism involves automatically debiting or crediting the clearing accounts of the members through a designated clearing bank. According to the standard timeline and schedule set by the clearing corporation, this transfer of funds, both pay-ins and payouts, must be completed before the market even opens on the next day. That covers the daily routine. So let us shift our focus to the final settlement of futures contracts. When the final trading day comes to a close, all open positions are marked to a final settlement price. This price is determined by the volume weighted average price of the underlying asset during the last 30 minutes of trading. Once that price is locked in, the system randomly assigns long positions to short positions. Depending on the type of contract, the final outcome will either be a cash settlement or a delivery settlement. Let us dive into the final settlement procedure specifically for cash settled futures, which applies to index futures. Here, T represents the expiry day and T plus 1 is the settlement day. On expiry, positions are marked to the final settlement price. To calculate the final obligation for brought forward positions, you take the previous price minus the final price and add the daily MTM. For newly opened positions, it is simply the trade price minus the final price. When it comes to funds, members who owe money must have clear funds available in their accounts by a declared time for the pay-in. After that, the clearing corporation credits the accounts of those receiving a payout. Now, let us compare that to the final settlement procedure for futures that require physical delivery, like stock futures. This also happens on the T+1 day. Instead of just moving cash, we are moving actual shares. The clearing member who is delivering the shares must send instructions to transfer them to the depository pool account before a specific cutoff time. The clearing corporation acts like an orchestra conductor here. They instruct the depository to credit the receiving member's account with the shares and simultaneously instruct the clearing bank to debit the funds from the paying member and credit the receiving member. To make this crystal clear, let us calculate some actual settlement obligations for physically settled futures. A long futures contract means you have a buy position, so you will receive securities. A short futures contract means you have a sell position, so you must deliver securities. For example 1, imagine a long position of 1500 shares at a final price of 475. The obligation is to take delivery and pay rupees 7,12,500, which is 1,500 multiplied by 475. The MTM difference is settled in cash. In example 2, with a short position, the member must deliver those 1,500 shares and the cash difference is credited to them. Moving right along, let us look at the settlement of options contracts. Just like futures, options have two types of settlement. The first is daily premium settlement. Whenever an option is traded, the buyer pays the premium and the seller receives it. The clearing corporation nets these payable and receivable amounts for each client and the actual payment happens on the T+1 day. The second type is the final exercise settlement. When an option expires, any contract that is in the money, meaning it has intrinsic value, is automatically exercised. Let us look specifically at the final exercise settlement for index options. These are European style options, meaning they can only be exercised on the exact expiry day. Any long in the money options are randomly assigned to short positions and the settlement mode is strictly cash on the T+1 day. For a call option, the value equals the closing price minus the strike price. For a put option, the value equals the strike price minus the closing price. For example, if you hold a call option with a strike of 17,500 and the index closes at 17,800, your calculation is 17,800 minus 17,500 multiplied by the lot size of 50. This equals a cash profit of 15,000 rupees. Now, let us contrast that with the final exercise settlement for stock options. These are also European style and exercised only on the expiry day. The exchange still automatically assigns long in the money positions to short positions. However, the critical difference here is the settlement mode. Unlike index options, stock options are settled by the actual physical delivery of shares following the delivery schedule set by the clearing corporation. Let us map out exactly what those physical settlement obligations look like for options. If you hold a long call option that is in the money, it results in a buy position, meaning your action is to receive securities. If you hold a long put option, it results in a sell position. So you must deliver securities. On the flip side, if you are the writer or shorten in the money call, you have a sell position and must have the shareholding ready to deliver. If you are short and in the money put, it becomes a buy position and you must have the funds ready to receive the securities. So how do we calculate the exact monetary value for these option settlement obligations? The golden rule is that the settlement obligation is always computed at the strike price. Let us look at example 4 for a long call. The strike price is 475. The stock closes at 510 and the lot size is 1500. Since it is a call, the action is to take delivery. The value is simply the strike price of 475 multiplied by 1500 equaling rupees 7,12,500. Example 5 shows a long put with the same strike and lot size but closing at 410. The action here is to give delivery, but the mathematical value remains exactly the same, calculated using the strike price. Finally, let us explore a very helpful feature called the net settlement of the cash segment and the futures and options segment. This concept allows obligations from buying cash shares and the physical settlement of derivatives to be offset or netted against each other. Imagine a scenario where a trader has a long put at a strike of 110 and on expiry day they buy shares in the cash market at 101. Under the old rules, they would have to pay 101 rupees to buy the shares and in a separate transaction deliver those shares to receive 110. But with net settlement, there is no funds paying required. The transactions cancel out and the trader simply receives the difference, which is 110 minus 101 equaling rupees 9. Just remember, to use this facility, you must trade and clear through the same broker and it is not available for institutional investors.